You didn't start a business to become a full-time accountant, but the moment you start ignoring the numbers start destroying your business. Today, we're breaking down the 5 deadliest accounting mistakes ruining local businesses and how to fix them before it's too late.
The real issue is like you forecast you're going to make this much money on a job, but you weren't watching your costs well enough, and therefore horrible feeling, and there's no way to make it up if you're done with that job.
Mistake number 1 hits the hospitality industry hard: plate cost creep. Your margins in a restaurant are razor thin. If your vendor raises the price of beef by 15%, but your menu prices stay the same, you aren't just losing margin, you are paying your customers to eat your food. You need an accountant tracking your cost of goods sold in real time, not just at the end of the year.
And there's only so many hours in the day, especially if they're also the chef and the chief cook and bottle washer and whatever else. And
Right.
so it's more of a feel than it is actual. And so when we're working with smaller business people, it's like, okay, I understand there's that feel and that you're there every day, but let's prove it to yourself.
Mistake number 2 is the silent killer of construction and trades: the cash flow choke. You won a massive bid. Congratulations! But if you have to front $50,000 in materials and payroll, and the client doesn't pay net $60,000, your business will suffocate.
They are going to wire that house, get that part of the job done, and then they got to bill that part of the job. They will come back in job to finish up other parts of that job. And so a work in process, and maybe the contract says you can only bid X amount on a job when it's completed. And there might be a retention involved, so that if you've got 50% of a job done, and we'll just, for ease, we'll just say the whole job at 50%, so you potentially could bid 50%, but there's a 10% retention that they're requiring of you. You could actually only bill $45,000 at that point in time, and you can't bill the rest of it until the job's completed. So those are some of the twists that you have involved.
Mistake number 3 catches sole proprietors and consultants off guard: treating a business like a hobby.
Are you separating your business from your personal?
Mm-hmm.
All right. A lot of people like to just say, hey, I got one checking account. I don't care. But if you're ever under question, it really muddies the waters so much as to what is a business expense versus personal. So it's really critical that there's a separate business account or banking account for that business.
Commingling funds doesn't just make tax time a nightmare, it completely blinds you to whether your venture is actually profitable. Get an EIN, open a business account, and act like a CEO. Mistake number 4: thinking a software subscription is a substitute for a CPA.
And so the other way is maybe you've gotten deposits, or you've ever paid for things, like you say you get a $30,000 deposit for, you can go out and buy the product, but you haven't put it in the house yet. You haven't done anything yet. And that would be a billing in excess of costs because you haven't earned any of that.
QuickBooks is a fantastic tool, but out of the box, it doesn't know how your specific industry works. A CPA doesn't just plug in numbers. They build the software architecture around your exact operational needs. And finally, mistake number 5, the tax time panic. If the only time you talk to your accountant is in April to file your taxes, you are driving your business 90 miles an hour blindfolded. By the time you realize you've lost money, the year is already over. Great accounting isn't about looking backward at what you spent. It's about projecting forward so you know exactly how to grow. Stop guessing with your livelihood. Get the financial foundation your business actually deserves. Contact Stephen J. Wick & Associates today, and let's get your books working for you, not against you.